Commonwealth Bank did not fall 10% because its quarterly profit disappointed. It fell because the number sitting underneath the profit, a $316 million loan impairment charge, with $200 million added as a forward-looking buffer, told the market that CBA's own management no longer believes in the benign scenario. That is a different kind of signal. CBA printed $2.7 billion in cash profit for the quarter, up 4% year-on-year, which under any normal read is a solid result for a major bank. The market erased roughly $25 billion in market cap anyway, the largest single-day wipeout in CBA's history. The disconnect only resolves when you understand what the provision increase actually encodes. Management has materially raised the weight on its downside macro scenario, citing Middle East supply chain disruptions, elevated energy prices, and weakening consumer sentiment that has now hit its lowest reading since the pandemic. CEO Matt Common named those three pressures explicitly, which means the guidance is not boilerplate caution. It is a specific set of inputs being repriced in real time. Consumer arrears rose across home loans, credit cards, and personal loans during the quarter. The personal loan figure moved 30 basis points, modest in isolation, but directionally consistent with a household sector that is losing capacity to absorb further shocks. Westpac, ANZ, and NAB each fell 1 to 3% in sympathy, confirming the market read this as a sector call, not a CBA-specific miss. The question that CBA's result raises, but does not answer, is whether this provision increase is front-running a policy-driven generation, because on the same day the bank reported, the federal government announced the most significant restructuring of Australian investment tax treatment in more than 2 decades.
The 2026 federal budget's headline housing story, limiting negative gearing to new builds from July 2027, was designed to shift capital from existing property into construction. The mechanism underneath that intention, however, points somewhere else entirely. By simultaneously replacing the 50% capital gains tax discount with inflation-indexed indexation and imposing a 30% minimum CGT rate on all asset classes, Treasurer Chalmers did not just reshape the property investment calculus, he altered the after-tax return profile for equities, ETFs, managed funds, and private trusts held by individual investors, while explicitly exempting superannuation funds and foreign institutional investors from the change. That exemption structure is the detail that the banks and small-cap analysts are focused on. RBC Capital Markets noted the budget was supportive for large diversified miners and established operations, but analysts warned that the CGT changes would concentrate their impact on individual retail shareholders, who are disproportionately exposed to small caps and growth names. The Financial Services Council called it a bait and switch, arguing that what was framed as a housing equity measure had been extended to compress returns across all capital markets. Fund manager Jeff Wilson described it as destroying young Australian ambitions and aspirations. The bond market responded. The Australian 10-year yield moved toward 5.08%, near a 15-year breakout level, as bond traders priced in that $18 billion in additional government spending would keep inflation elevated for longer, and that the RBA, which had explicitly requested spending restraint, had been overruled. That yield pressure is a second-order headwind at the banks, since rising rates on the long end compress the margin relief that the Big Four were expecting from the rate environment normalizing. CBA's provision increase and the budget's structural shift on capital returns are not independent events running in parallel. They are converging signals that the household and investment sectors face a more constrained medium-term outlook than the prior consensus assumed. What that convergence has not yet resolved is why one major segment of the ASX is moving in the opposite direction entirely.
BHP hit a fresh all-time high on the same day CBA suffered its worst single-day fall in history, and that contrast is not a coincidence of timing. It is a compression of the two dominant forces reshaping the Australian equity market. Copper broke above US 6.58 per pound on Wednesday, a new record, driven by Chinese industrial demand that has remained resilient despite geopolitical headwinds, combined with supply-side tightness and structural consumption from AI data center build-out. The Australian Bureau of Statistics had already flagged that Australia ran its first monthly trade deficit since 2017 in March, partly attributed to surging imports of automatic data processing equipment, the physical expression of data center investment reaching scale. That same data center build-out requires copper at a rate that industrial infrastructure historically has not. BHP's copper division now accounts for more than half of its EBITDA, which means the company's record market capitalization of approximately $313 billion is not a story about iron ore or diversification. It is a copper price bet that the market is paying a premium to hold. BHP displaced CBA as the ASX's largest company on Wednesday, a reversal that would have been considered structurally improbable 12 months ago. Rio Tinto and South32 followed BHP higher, confirming the copper signal was sector-wide rather than company-specific.
The forward question is whether the copper thesis is durable enough to sustain BHP's premium against two counterforces: the budget's CGT changes, which reduce the after-tax incentive for individual investors to hold high-performing assets, including BHP, and the oil shock running through the broader economy, with Brent crude at $107.50 a barrel adding inflationary pressure that could eventually force the RDA to respond in ways that compress growth assets. If copper holds above US 6.4, the level BHP cited in its record high run, and Chinese industrial data for May remains above contraction, the materials sector has a plausible case for continued outperformance. If copper pulls back below that threshold while the long bond yield holds above 5%, the ASX faces a rotation where neither financials nor materials provide the lift that has kept the index from deeper losses. CBA's $316 million provision figure is the number to watch next quarter. If it rises again, the budget's housing policy has not yet found its floor. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.